Hey, everybody, I'm hoping you're having a great and wonderful day and keeping warm in the great state of Idaho. We're going to go over rates today because it was really all about rates this week. So, what happened? Let's talk about Tuesday first. Consumer Price Index came out. This is inflation. Inflation is bad for mortgage rates. And it came out at a 0.1% increase month over month. This was significantly better, and it replaced a last year's number of like 0.6. So the inflation dropped. Inflation dropped kind of dramatically. And what it really didn't do is it didn't take into account some lagging indicators, specifically rent. So we are going to continue to see inflation's drop off. That helped rates improve quite a bit. Then on Wednesday, the Federal Reserve came out. Remember, when the Federal Reserve increases their rate, it doesn't affect mortgage rates. Meaning, if they increase a half a point, mortgage rates go up a half point. This is totally false information. I've seen Facebook posts, I've seen flyers, I've seen a lot of stuff that says, "Oh my God, the Fed raised rates. You should refinance now." This is lies on this one. Sorry on my soapbox a little bit. But the Federal Reserve came out and was a little bit more dovish on interest rates than they were last time, where they were a lot more hawkish. We'd like them to be doves. And with that, we had interest rates improve a little bit. So I'm going to look at the charts real fast, but I want to show you where we're heading, hopefully where we're heading. So this number right here is where was last month's CPI index. Huge improvement, almost a full point of improvement in one day on interest rates. Then we kind of stayed a little flat with some little slight improvements. Then on Tuesday, this is the consumer price index again. We had a very, very nice improvement on that one. A little bit of a pullback, but very nice improvement. Then Wednesday, the Federal Reserve came out and was a little bit hawkish. What this really did is if you see this red line here, that's called a resistance line. It's a Fibonacci line, and it's quite a bit of resistance on it, whereas these down here are support. So we're going to probably trade in this era for a little bit, which is about a 6.25% interest rate era. Now, what's going to happen when we bust through this? This is about the end of the sixes. If on Tuesday, when the Federal Reserve when the bond rates ticked all the way up here, we actually saw 5.97 for about an hour and a half, really and truly. Then everything pulled back a little bit. So this is the fives. So between this red line and about right here, we're going to see the fives. And that would be 5.9 and all the way lower. As fast as this has moved in the last 60 days, we actually could see fives in the next 30 to 45 days. This up here is kind of the threes. And it may look like quite a bit, but it's really not as volatility as the market has been. I don't think we're going to see the threes until we get some spectacular consumer price index. And we see the Federal Reserve use the word pause. So that's going to be the key. But we can definitely see the fives and into the fours. And that's what we're really, really going to watch. So kind of the moral of the story is rates are starting to drop. They're actually dropping a little bit more rapidly than we anticipated, but it's good news. And that is all come down to the consumer price index. Now, again, if the consumer price index is not good in January, and I don't have the date of when it's coming out, but usually mid-month on this one, it could force the Federal Reserve to continue their rate increases. Again, doesn't affect us, but it does say that inflation is out. So kind of the moral of the story is, as real estate agents in talking to your consumers, is interest rates are starting to fall, and they're falling quite nicely. Again, we could be in the fives next week, maybe the week after, depending upon some economic news. And so with home prices and sellers giving away the farm right now, and interest rates at some of their lows for the last 4 or 5 months, it's really, really a good time to buy. So with that, thank you very much as always. I appreciate your business as always, and make it a great day.